How should investors invest in China? What are the specific sectors that are growing the fastest? And of course, the risks associated with investing in Chinese investments. Joining us today to talk about this topic is Brendan Ahern, CIO of KraneShares. KraneShares has a variety of products with exposure to China of various sectors. Brendan, welcome to Kiko. This is your first time on the show.
Thanks for having me, David. Very much looking forward to it.
China is not a jurisdiction we talk about a lot on Kiko, but I wanted to delve into this subject because you are an expert on Chinese investment strategy. Let's start from the top down before we get into the specific sectors. As you know, the 14th five-year plan from the government of China has been released not too long ago, and the five-year plan is their way of projecting growth and outlining their forward guidance into the next 5 years. Specific themes of the last five-year plan include prioritizing the quality of growth rather than the quantity of growth, building China's self-reliant technological manufacturing sectors, and elevating China's leadership role in regional and global economic governance, and of course, their management of great power rivalry with the United States. Specifically, they want to achieve certain climate goals by 2023 and 2060 and beyond. And they're progressively moving towards a lower carbon economy. So given the government's outlook and their plans going forward, how would you as an investor play this theme? Or I guess a multitude of themes.
Yeah. I mean, as investors, we want to align ourselves with China's top-down driven policies, that these policies will drive a lot of money, that people want to align themselves. And we as investors want to sit on the same side of the table as those investment flows. And so we see a multitude of opportunities around China's growing domestic consumption, of which 30% takes place online. We know the standard of care around healthcare needs to be raised due to China's demographics. And to your point, David, China's increasingly become aware of the environmental consequence of being the world's factory and has dedicated itself to peak carbon by 2030, carbon neutral by 2060. And we believe this will have a very positive effect for electric vehicle manufacturers, the broader EV ecosystem, battery makers and such, but as well as solar and wind manufacturers. So there's a multitude of opportunities by simply aligning ourselves with these top-down driven policies.
If you look back at the past five-year plans, let's take a look at the track record of the government of China. How well have they actually managed to achieve what they set out to achieve in the past?
Well, the track record is quite strong because they have mileposts on a semi-annual basis where they check up, have policy meetings to ascertain that they're on their way to meet this objective. And so in the case of, say, electric vehicles, they've said that they want 25% of all auto sales to be EV. And that's up from 5% in 2020. And we're already seeing EVs as a percentage of total auto sales picking up. And again, that goes back to the EV ecosystem is going to be a beneficiary, miners, technology providers, battery makers. And again, we've really aligned our ETFs along with these broader Chinese strategies. And some of these strategies we think originating in China will happen on a global basis. So we actually had the first global electric vehicle ETF, our ticker CARS, which takes advantage of something that we saw in China, but we think is going to happen on a global basis.
So what does it mean for Chinese companies, private and state-owned? Well, there's a murky line in China between the state-owned companies and the private ones, but what does it mean for Chinese companies when the government introduces a new five-year plan every 5 years? Do they have to realign some of their corporate strategies with the government, or can they continue operating as they were?
Well, I think one, in China, you see people changing jobs based on the new five-year plan, that if your company you're working for is not one of these favored sectors, you want to align yourself with a company and a sector that is. So we actually see movement there. I think a lot of investors are surprised that the vast majority of employees in China work for private companies. They don't work for state-owned enterprises. the public element of China's economy is significantly larger than really the state-owned enterprise driven. And that's somewhat driven that over 50% of China's GDP is driven by the service sector. So China's become a consumption-oriented economy, much like like many Western economies. And that's driving a very, very big shift in employment. And again, the vast majority of people in China work for private enterprises.
Okay. I want to bring our audience to the attention of one of your ETFs, KARS, KARS. It's trading on the NYSE. Over the last 1 year, so in the trailing past 12 months, it's up about 80%, 80-90% on my eyeballing right now, the chart. So it's done exceptionally well. Tell us about this index, what's in it, and why has the Chinese automobile sector, specifically electric vehicle sector, performed so well over the last, it's not just the last 1 year, by the way. If you scroll past, it's the last 2 years as well. So what's driving this growth in China?
Yeah, I mean, several years ago, the environmental situation in China kind of reached a breaking point. And so an element of that was trying to remove older internal combustion engine, gasoline cars, older cars. So they got those off the road. But there is a big push to make EV successful in China. And, being in Beijing back in June of 2017, I actually took a photo of a Tesla showroom in Beijing. And, it made us realize that, that a lot of investment dollars are put on Tesla. And the reality is traditional automakers as well as upstart EV makers are really going to give Tesla a run for their money. If you think about companies that have been making cars for 100 years, when they pivot toward EV, it's going to have a tremendous competitive threat to Tesla, as well as Tesla makes luxury cars. In China, we see a lot of much, much lower tier EV providers, but it is an ecosystem that you've got miners, cobalt, lithium. You've got technology providers. You have battery makers. The largest battery maker, CATL, is listed in mainland China, very difficult to access. But this is a global phenomenon. So KARS has really a global portfolio. It's very much geared to this mega trend of global EV adoption.
So Brendan, can you give us a few names of the companies inside this ETF, inside this index? Is it all domestic companies within China, or do you have some foreign auto manufacturers as well?
No, it is very much global in nature. That yes, you have companies like Tesla, NIO. You have a whole host of the EV side. But I think what's interesting to me is the largest holding, a company called CATL. This, again, is listed in mainland China. It really is the dominant player in electric vehicle battery manufacturing. They have deals with virtually every auto manufacturer globally. And again, CATL, because it's listed in mainland China, it's very, very difficult for an individual investor to access. And I think it's an example of a company that, if you put all your chips on Tesla, and again, it's a company I'm rooting for, I think you're missing out on a much, much broader opportunity set.
And, the Chinese government has in the past and currently provided subsidies for anybody wanting to buy electric vehicles, producers of electric vehicles as well. A lot of their buses are electric because of these subsidies. Do you think these subsidies will likely end going forward? And if so, what would that mean for demand for EVs in China?
Well, I think, the EV bus maker BYD is a great example. It's famous for Berkshire Hathaway taking a stake back in 2009 that $200 million investment is worth nearly $6 billion today. But yes, there were subsidies to support the industry, to help it get off the ground. Those subsidies are being slowly weaned down. I don't think it's going to have a materially negative effect on the Chinese automakers, simply because these are great cars they're making. They're people want to drive them. They're very economical, very cheap to run, cheaper to buy versus a Tesla. So I don't think this lack of subsidy support is going to be a tremendous headwind for the space.
So as an investor, would you be positioned more towards, again, domestic Chinese vehicles or foreign manufacturers? Because keep in mind, we do have a rising middle class in China. They are down the line able to afford more cars along the lines of Teslas and other luxury vehicles. So are you banking on a rising a group of competitors from the domestic side? Or are you banking on the fact that the Chinese will be able to afford foreign cars en masse?
Well, I think for the China space, you want to be overweight the domestic players that, due to the trade war, there's tariffs on importing cars from outside of China. So you've got companies, Guangzhou Auto, BAIC, Geely, BYD, that are going to benefit from that domestic demand, the lack of tariff. So on the China side, you definitely want to be aligned with the local players. I think globally, you're going to see a real pivot over the next several years where traditional automakers get into the EV business. You're seeing Ford, most notably, dip their toes in this with the new Ford E-Mustang. But you're going to see Daimler, Benz, Audi, and others, Volkswagen, get into this EV business very seriously.
Oh, for sure. Yeah, like every single car ad I've seen is an ad for their new EV lineup. Even Hummer, I was telling another guest, Hummer is producing electric vehicles now. It's ridiculous. Let me ask you this, Brendan. Do you think Chinese automobile manufacturers are going to be able to compete internationally at some day? Do you think there's any brand within China that's going to be the next Toyota or Hyundai?
I think the EV space, it potentially could, where a lot of the EV from Tesla is really focused on the luxury market. At the same time, in China, it's really about mass production. Providing a much bigger audience. And so there might be an opportunity for a Chinese player to appeal to that mass market. At the same time, politics do matter. That domestic auto manufacturers in Europe, in the United States, and Canada employ a lot of domestic employees. There's going to be a lot of protection around allowing that. We saw that in the U.S., where a lot of foreign automakers now manufacture in China, in the United States, because of tariffs on imports. So I think if they want to do so, they're going to have to do so with local domestic manufacturing in those foreign markets.
So how much does the Biden administration's attitude towards China affect your investment strategy within the country?
Well, as investors, we've noticed that there's been a lot of political bark. There's a lot of political rhetoric. At the same time, there's very little economic bite to it. So I think it's been more of a factor on sentiment as opposed to actually hurting the fundamentals of either economy. I mean, if anything, the trade war really did hurt U.S. manufacturers and U.S. consumers, since they actually wrote the check on the tariffs. China doesn't write the tariff check. So I think the tariffs were basically a failure. It didn't accomplish anything. And so I think it's important. Recent trade data that was released showed that China's exports and imports to the United States is exceedingly strong. The same is true with China and Taiwan, China and Australia. But you see from the traditional mainstream media, this constant barrage of negative political rhetoric. But the reality is there's been very little economic bite to it.
Well, let's put it this way. Do you think there ever could come a point where the relationship between the Chinese and the Americans could deteriorate to such an extent that your investment within China could no longer be deemed safe?
I don't believe so. U.S. companies that are publicly traded generate nearly $400 billion of revenue annually. You have to remember that the definition of trade is something that's put on a boat. And a lot of American companies own factories in China and in Asia simply because there's 4 billion people that live there. And you put the factory over there just because it's logistically makes sense. You want to tap that huge consumer market. But if you think about it, because those factories are located in China, it doesn't show up in trade data. And that's a very significant number. If you think about Apple or Nike or Starbucks, all that money flows back to the United States, but it doesn't show up in any trade data. And I think these economies are very, very intertwined with one another.
So geopolitics are not really a concern for you from an investor's perspective. What about other tail risk you're looking at? What could possibly keep you up at night, so to speak, as an investor with money in China?
Well, I think you have an issue around U.S. listed companies due to the Holding Foreign Companies Accountable Act, which, due to a long-running issue between the PCAOB and where they've not been allowed to audit the audit papers of U.S. listed Chinese companies. You have this potential issue of delisting of U.S. securities, which the 3-year clock hasn't started. It's not expected to start until 2022, which many believe finds an opportunity to solve this long-running issue. So that is a risk, but institutional investors like ourselves, we would simply convert out of the U.S. listing into their Hong Kong equivalents. So I think it's potentially a bad headline. But again, institutional investors like ourselves, you can convert, say, out of Alibaba US into the Hong Kong share class. It's done overnight through your custodian. It's very easy to do. But I think the U.S. regulatory is a little bit of an issue that is obviously out there.
I want to draw attention to one of your other ETFs, KWEB. This is called the CraneShares CSI China Internet ETF. This one has had an interesting performance profile. It's had a nice run up earlier in the year, and then it fell back down and wiped out most of the gains from the last 1 year. So didn't perform as well with cars. And interestingly, it's an internet ETF. But if you mirror this next to NASDAQ, the NASDAQ performed much better. So why is that Chinese internet stocks lag behind their American counterparts in the last year?
Yeah, I mean, in 2019, 2020, we did KWEB had very strong returns, and that continued in the beginning of 2021. We've had a number of factors. You had Archegos, the hedge fund that was liquidated. 5 of its 10 holdings were U.S. listed Chinese companies. You have a little bit of a value growth rotation where investors have been overweight growth or FANG stocks, and as commodities rally, cyclical reopening trade, you have to fund that from somewhere. And that is the global issue, that investors were overweight growth and have had to rebalance into some value plays. But I think the China regulation of these companies has really weighed on sentiment. That's despite we haven't seen the fundamentals of any of the companies hurt thus far. And then you do have this U.S. regulatory issue around the Holding Foreign Companies Withholding Act. Now, again, you go back, the fundamentals of the companies have never been stronger. We had very, very good earnings in Q4 reported in February. We had the Q1 earnings were very strong for these companies. And in August, we'll get the Q2 2021 earnings, which are expected to be very strong. So you have this interesting disparity between the fundamentals of the companies have never been stronger. They're adhering to the China regulation. The fundamentals, the net income, it doesn't appear to have been hurt. So it's more of a sentiment issue. And I think I would contrast the performance of the Chinese A-share market, which has been quite robust, which is mainly owned by investors in China who say the economy is doing well, with that of foreign investors who, again, were met with this constant barrage of negative media attention, has really weighed on Hong Kong and U.S. listed Chinese companies. It's a really interesting disparity.
Well, how is the internet sector within China evolving? Do you see any companies becoming the next Facebook in the sense that they're going to be used internationally? Obviously, the Chinese tech companies are used widely within China. In fact, many of them are linked to the government in payment systems in their everyday life. WeChat is one example. So is the next WeChat going to be the next Facebook? Is it going to be used by pretty much every single corner of the world, do you think?
Well, I mean, ByteDance's TikTok, it has gone global in a big way. But that is a private company. I think the companies will continue to focus on China. China's urban middle class spends 7.4 trillion annually. The size of China retail sales matches that of the United States. But 30% of all retail sales takes place online. We just had the June retail sales reported. It was quite strong. But at the same time, retail sales online grew at almost 24%. So almost twice what total retail sales growth. So I think these companies have a tremendous growth opportunity domestically in China. You're seeing some of them go into Southeast Asia. Alibaba bought a company called Lazada that's focused on Southeast Asia. So I think naturally they'll ply their wares in that segment of the world. But I think the focus on user data globally in both Europe, here in the United States, as well in China, probably hinders some of the more global ambition.
Okay. And finally, let's talk about the broad index as a whole, the A shares index. You have an ETF that tracks that, by the way. It's called the KBA. The A shares index did have a huge run up in late 2014, and then subsequently the bubble popped in 2015. What happened there?
Well, back then, and KBA was one of the only ways to garner exposure to Chinese A shares. You had a margin debt fueled equity rally. And subsequently, the regulators in China cracked down on the use of margin, both legal and illegal. And we're in a very different place. China's the Chinese A share market is the second largest in the world. We're seeing it being added to indices such as MSCI emerging markets. So we think this is a market that's too big to ignore. We're starting to see the idea of China as an asset class percolate. That China's economy, as the second largest in the world, China's stock market and bond market also the second largest in the world. You have to break it out as an asset class, similar to what we've seen with Japan. Back in 1989 with MSCI creating Asia ex Japan. We think we're headed to a world of EM ex China investing, simply because China's too big.
Yeah, okay. And your outlook on the Chinese stock indices as a whole, do you think the A shares index, or perhaps even the Hang Seng in Hong Kong, could outperform the S&P 500 within the next 1 to 2 years?
Well, I think from a valuation perspective, Chinese as well as broader emerging markets are considerably inexpensive relative to their U.S. equivalents. KWEB now has a PEG ratio of under 1 versus U.S. Internet's over 2. In the case of the Chinese A shares, like KBA, you're benefiting from what the local investor thinks about the local economy. And that's very different from what foreigners think about China. So, we're optimistic. We think there can be communication and dialogue between the U.S. and China. Biden isn't going to go soft on China. At the same time, the economies are far too intertwined. There is no pulling that apart. It would have we're just too far along.
Well, I think a large percentage of S&P 500 companies' revenues, I think it was like something like 30 or 40%, is foreign. So I wonder how much of those foreign revenues are actually based in China. I don't know if you have
Yeah. The New York Fed, they put the number of this was 2 years ago at 376 billion of publicly traded U.S. stocks. Revenue is generated in China. For many semiconductor companies, it's much higher. Obviously, companies, some of the consumer-focused companies are tapping into China's urban middle class. The Nikes and Apples, Starbucks. So it's been really tight, but increasingly it's energy. I think a lot of investors are surprised that Texas just overtook California as the largest exporting state to China, and that's driven by oil and LNG. So there's a lot of different U.S. companies are doing very well in China today, and hopefully the politicians can sit down and or pick up the phone, get on an airplane, and figure it out.
Yeah. All right. Well, we'll follow up more on this story. Thank you so much, Brendan, for coming on to the show today.
My pleasure, David. Thank you.
And thank you for watching Kitco News. I'm David Lin. Stay tuned for more and follow us on Twitter at DavidLin_TV. And of course, subscribe to our YouTube channel.